Step two is to determine what constitutes a mistake. What is it about that investment that is going to make you say, ooh, I knew, or I was worried, and this confirmed that this wasn't something that I should have done. And this part of the process speaks to how you evaluate the investment itself, and it's going to change based on what you're evaluating. For example, we talked about making an investment recommendation or an investment management recommendation. And the temptation when you're evaluating an investment is to just simply look and see whether it had positive performance. And that's your indicator of whether it's doing well or not doing well. When in actuality, most investments or investment managers have a benchmark. They have a portion of the market or a composite of the market that they're using to track its performance and compare its performance. For example, if you're looking on screen, there's what we call a fact sheet from an investment called the Vanguard Life Strategy Moderate Growth Fund. This is an index fund that's very popular in the Vanguard umbrella, and it's for moderate investors. As a matter of fact, if you look at the risk level on this fact sheet on a scale of 1 to 5, it's literally a 3 right down the middle. It has a low expense ratio of 0.13%. And you'll see on this page, not only over the course of these 2 pages, the investment strategy, the investment components of this investment, its performance over time. You will also see what it's using as its benchmark, and you'll see the performance relative to said benchmark. For example, the benchmark for the VSMGX fund is the Moderate Growth Composite Index. So that is some compilation of investments that they are going to consider once altogether a moderate investment. It may be that 60% of it is large cap value stocks and 20% is large cap growth stocks, and maybe 10% are treasury bills or international bonds. But whatever portion of the market they're tracking, that's what they're using to evaluate performance. And you can see that performance over time. For example, year to date, the fund itself is up 7.89%, which is higher than the performance of the benchmark, 7.74%. Over the course of 10 years, however, it's basically in lockstep. The fund has performed 7.05, the benchmark 7.36. This is something that you see with a lot of index funds where the performance of the benchmark and the fund are very similar, because the goal of most index funds is not to make a bunch of decisions separate from the index. It's to simply follow it as closely as it possibly can. And this is something that would let me know, hey, this is actually performing as indicated and as intended. So if I'm looking at this investment after, say, 3 years, and I'm upset with the performance, it may be that I have improper expectations and it's actually performing the way that it's intended to perform. It just so happens that it's been a rough few years. Or if I'm looking at it and I'm saying I'm disappointed, maybe I chose the wrong investment for me, and I have the information to go find a different benchmark or a different fund in terms of what it's tracking that suits my risk tolerance. For insurance policies, like we discussed, there are a number of factors that can help you determine whether it's true underperformance of the policy itself or whether it's a broader economic function. For example, there are permanent life insurance policies called variable universal life policies. And in those policies, your cash value is invested in sub-accounts that are very similar to what you would see in like a mutual fund. Well, if you found a policy that's quote unquote underperforming, it may be that you've just chosen the wrong sub-accounts, and you could find different sub-accounts or a different allocation that would perform better, but it doesn't mean that the bones of the policy are poor. There's also index universal life policies where the cash value is tracking the performance of an index like the S&P 500. And maybe it's just that the S&P 500 has had a couple rough years, or it could be that if you think you've chosen the wrong index and there's the opportunity to switch within that policy, that you could do so. But again, the bones of the policy are just fine. On the other hand, there are a number of factors that might say, no, this isn't performing the way that I expected. For example, you have whole life insurance policies where at the beginning of the year, there's going to be a dividend rate that's declared. And that is essentially the interest that's credited to your cash value that's guaranteed for the year ahead by the insurance company. Well, many people will look at the historical dividend rates of a company to make their decision in part, as to which whole life policy they'll choose. But if you get into that policy and the rates have changed and they've gone lower and they're much lower than you've expected, and you don't think that they're going to increase in the near future, then you may have to make a decision over when is the time where you fish or cut bait on that policy. Do you wait till the 10th year where the surrender penalty has expired and you can walk away with all of your cash value? Or do you want to get out of it even sooner and not throw more money at the policy with the understanding that it's going to cost you penalty fees to walk away before that first 10 years has expired? With a real estate property, make sure you're bringing the right considerations to the table in the evaluation. If you're upset that the values of the property haven't increased, but it's already a property that you were doing for a long-term rental play, then you may be thinking about the wrong things, right? The value doesn't have to have increased in the first 3 years if in the long term it can still be a profitable rental property. However, if you were trying to flip the property and the values haven't increased, that's a big factor in your decision-making process. And step three in the process is determining whether that mistake can be corrected. If it were an investment, maybe you sit in on the quarterly calls where you can hear the mistakes that they feel they may have made or the market forces that have led to underperformance. You'll find the same with an investment management company. You can decide whether in the long run you agree with their path forward or whether you want to cut bait. With an investment property, if it's a short-term rental, can you increase the rents by having better marketability? If it's a long-term property, are you looking for the wrong type of tenants? Is it because you're paying a property manager too much money, or is it because you have the wrong property manager? If it's costing you more in upkeep, do you have the right maintenance person looking after the property, or do you need to spend some money now that will save you in the long run by getting things like a new hot water heater or a new HVAC unit so you don't have to keep paying for repairs? All of these considerations factor into determining whether it's something that's not working out right now but can work, or whether you've truly made a financial mistake.